Right now, most people believe one thing about whales. They think whenever big money enters crypto, price explodes instantly. But that's not how smart money actually operates. In reality, the largest players enter positions without moving the price at all, while retail is still waiting for confirmation. And by the time price finally moves, smart money is already positioned. Most retail investors experience the same frustration every cycle. They spot a strong project early. They wait patiently. Nothing happens. Then suddenly, price explodes. They panic by the breakout, only to watch price pull back days later. Later, they ask the same question. How did whales buy so early without pumping the chart? The answer isn't insider information. It's execution strategy. In this video, I'll break down how smart money enters crypto positions quietly without creating price spikes. We'll cover how institutions think about liquidity, order flow, market structure, and time-based accumulation. This is the same logic used by hedge funds, and professional desks, simplified so you can actually understand it. If you want data-driven crypto insights instead of hype and noise, make sure you're subscribed. This channel is built for people who want to think like smart money, not chase pumps. Core truth. Price moves last. Retail believes price movement signals opportunity. Smart money knows price movement ends opportunity. Whales don't want price to move while they're buying. They want stability. They want predictability. They want liquidity without attention. That's why real accumulation looks boring. If price isn't moving, that doesn't mean nothing is happening. WHY moving THE price ISBADFO are whales. When price moves fast, whales lose control. Large orders cause slippage. Liquidity dries up. Competition increases. If a whale market buys aggressively, they raise their own entry price. Smart money avoids that at all costs. Their goal is simple: maximize position size while minimizing market impact. 1. Range-based accumulation. The most common smart money strategy is accumulation inside a range. Price moves sideways. Volatility compresses. Retail loses interest. Whales slowly buy near range lows and pause near range highs. They repeat this process for weeks or months. To retail, it looks like a dead chart. To whales, it's a controlled environment. This is where retail usually gives up, right before accumulation completes. 2. Order splitting. Whales never place large visible orders. Instead, they split orders into hundreds or thousands of smaller pieces. These orders are spread across different price levels, different times of day, different platforms. This prevents sudden volume spikes and keeps price behavior natural. Retail sees normal trading. Whales build massive positions. 3. Time ISTHE advantage. Retail wants results quickly. Smart money uses time as a weapon. Institutions don't care if accumulation takes 30 days, 60 days, or 120 days. They care about average entry price, not instant gratification. This patience is something retail almost never matches. Pattern interrupt. Smart money isn't smarter because of information. It's smarter because of discipline. 4. Buying when volume disappears. High volume attracts attention. Low volume creates opportunity. When selling pressure fades and volume dries up, whales step in quietly. No hype, no headlines, no excitement. Just consistent buying against weak sellers. Retail avoids low-volume markets. Whales prefer them. WHY retail misreads accumulation. Retail associates activity with opportunity. If nothing is trending, they assume risk. If no one is talking about it, they assume something is wrong. Whales think the opposite. Silence means less competition. Less competition means better entries. The market doesn't reward attention. It rewards preparation. HOW smart money uses negative sentiment. Whales don't fight fear. They wait for it. Negative sentiment pushes retail to sell early. That creates supply. Whales absorb the supply patiently. They don't argue on Twitter. They don't predict bottoms. They let emotions do the work for them. WHY whales avoid breakouts. Retail loves breakouts. Whales hate them. Breakouts mean crowded trades, emotional buying, unpredictable volatility. Whales already own their position by then. Breakouts are for distribution, not accumulation. If you're excited to buy, you're probably late. Smart money vs retail execution. Retail buys based on hope. Whales buy based on structure. Retail uses market orders. Whales use limit logic. Retail reacts. Whales plan. That difference compounds over cycles. Quiet accumulation doesn't guarantee immediate upside. Markets can remain range-bound longer than expected. Macro conditions still matter. Smart money accepts this risk because positions are sized intelligently. Retail fails not because of bad ideas, but because of bad execution. HOWYOUCA and apply this thinking. You don't need whale capital to think like a whale. Focus on range behavior instead of hype, time instead of timing, risk control instead of prediction. Stop expecting price to validate you instantly. If you wait for confirmation, you're paying a premium. Smart money doesn't announce entries. They don't chase excitement. They don't need attention. They enter quietly, patiently, and deliberately, long before price tells the story. If you want to stop buying after the move and start thinking ahead of it, this shift in mindset is essential. If this breakdown helped you understand how smart money really operates, subscribe for more data-driven crypto insights, and I'll see you in the next one.